Welcome back to Your Average Investor, the channel that looks at my journey through investment, budgeting and finance. In today's video, we're going to take a look at what I and many other investors consider to be potentially the best index ETF out there, and that's the S&P 500 ETF. With its strong historical growth and the fact that many well-known investors such as Warren Buffett support it, it's taken its place in the Hall of Fame. This is due to the exceptional bull run the S&P 500 has had in the last 10 years, and the fact that in those 10 years it's offered an excellent rate of return to its investors. As we've already looked at, ETFs are an excellent way to invest, keeping fees low whilst also having massive diversification, and the S&P 500 is no different. Personally, I really like Vanguard's S&P 500 ETF, and that's the one that we're going to have a look at today. After that, we'll take a look at my own Vanguard portfolio, as the stock market had a particularly good week last week, and also I've made some further investments into my portfolio. So without further ado, let's hop onto the Vanguard platform and take a look at the S&P 500 ETF.
By looking at this at first glance, you can see that there are currently 3 different products from America offered on Vanguard within the United Kingdom. If you look at all of the American funds, you'll notice that each year over the last 5 years, they've netted a positive rate of return, even in the last year. If you look a little deeper, you'll notice that of the 3 funds, the S&P 500 has consistently made the greatest rate of return, with the exception of the 16-17 year and the 18-19 year, where the US Equity Index Fund made a slightly greater rate of return. The S&P 500, or the Standard & Poor's 500, is an index that tracks the largest 500 American companies by market capitalisation. Because all these companies are blue chip companies, which have seen excellent growth in the last 10 years, people want to invest in them. However, it can be very costly to invest in each individual company. Because of this, many companies such as Vanguard and iShares have created S&P 500 ETFs, which track the performance of the underlying S&P 500 index. This means that as a collective, if the companies within the S&P 500 increase in value, so will the ETF that tracks the index. This gives you excellent diversification and means that you can invest in some of the best companies in the world for a fraction of the price. If we have a look at the Vanguard S&P 500 ETF, we can see that the current value of one share is £46.41, with an ongoing charge fee of just 0.07%. This is largely unbeatable in the world of investing. One of the downsides, however, of investing in this product through the Vanguard platform is that you have to have enough money to invest in one share of the fund. Comparatively, if you invest in Vanguard's S&P 500 ETF through Trading 212, you can actually invest in this fractionally, meaning you can choose to invest just £20 into the fund and you'll get a fractional proportion of the share. For people starting out investing, or for those who can only spare £25 a month, this may be the better option. If we have a look at the performance of the S&P 500, you'll notice that even over the last year, even with coronavirus, the oil crisis and everything else that's been happening, the S&P 500 is still trading in a positive rate of return for the year. While this may only be a small rate of return, largely it's outperforming the majority of the indexes worldwide. There is a reason underpinning this, which we'll explore in just a moment. However, if you look at the performance of the S&P 500 ETF over a longer period of time, you'll notice that it's steadily increased in value year on year, showing excellent rates of return in one of the longest bull markets in history. From an investment of just $10,000 in April 2012, that same investment today would be worth above £25,000. This is over a 150% return in just 8 years. When compared to other ETFs like the FTSE 100, this S&P 500 ETF really is the gold standard with regards to capital growth. By taking a deeper look at the portfolio data, you can see that the region exposure of the S&P 500 is 100% to North America, which you would expect. And furthermore, the market allocation is 100% to the United States, which again falls in line with the underlying index. Interestingly, if we look at the weighted exposure of the S&P 500 ETF, you'll be able to see that there's a large amount of weighting towards information and technology, with it making up 25.7% of the underlying index. The rest of the fund is broadly diversified over a number of different sectors. Interestingly, the large weighting toward information and technology could be part of the reason why the S&P 500 is performing so well throughout this crisis, and also performing so well over the last 10 years. If we look at the holding details, it becomes more apparent what I mean. You can see that this ETF is made up of massive American companies, with Microsoft, Apple, Amazon, Facebook, Alphabet, so Google, Johnson & Johnson, Berkshire Hathaway, VUSA and then JP Morgan Chase being the top 10 holdings within this ETF. Obviously, throughout this crisis, with people going online and shopping online, information and technology has been really boosted throughout this time. and therefore the value of these companies have also increased at a greater rate when compared to other companies within this fund. Furthermore, if we look over the last 10 years, there's been a massive push towards the internet, with more people shopping and working online. Amazon's now become a household name, and most households own at least one Apple product. Because of the large weighting towards these companies could be the reason behind the large market push over the last 10 years, with these companies pulling the S&P 500 in a positive direction, whereas some of the companies down the lower end of the S&P 500 haven't been performing so well. If we take a look at this in a bit more detail by looking at the individual companies on the S&P 500, you'll notice that some companies have had some excellent rates of return in the last year. Amazon is one of those, sitting at 14th. Apple's down at 81st, still with an 8% rate of return. You've got the Alphabet Group at 91st and 92nd with around a 7% rate of return on the year. You've also got Johnson & Johnson at 130th, which doesn't make up one of those information technology companies, but still has a large weighting within the S&P 500 index. You'll then notice that only 140 companies have had a positive rate of return for the year, whereas the remaining 360 companies have actually had a negative rate of return on the year. So if we have a look back at Vanguard's S&P 500 ETF, you can see how the performance of these top 10 companies can massively influence the overall value of the fund. Now, this has had a really positive effect on the ETF over the last 10 years, because these companies have been growing an exponential amount. On the flip side, this could also mean if one of these companies performs really poorly or has some serious financial issues, which shouldn't happen, but could, it would impact the overall value of the ETF more greatly than a lesser company. Now, while this doesn't worry me, as I believe in these 10 companies and I think they'll continually grow for the foreseeable future, it's something that should be considered when investing in this fund. If you have a look at the dividend of this ETF, you'll notice that it's around 1.7% per year. However, it is paid in dollars. Now, this means that it will be somewhat subject to the exchange rate of the dollar and the pound at the time of the dividend pay date. However, again, this doesn't worry me too much because of the growth that the fund usually gives. So Vanguard's S&P 500 ETF on the whole is an excellent product, which offers excellent growth opportunities whilst also paying a small dividend per year. If we have a look at my recent investments, you'll see that on the 27th of May, I increased my positions in each of the ETFs I invest in: the emerging markets, the S&P 500, the FTSE 100 and the FTSE Developed Asia ex-Japan. I also decided to invest around £80 in cash. Now, this is so that throughout the next month I can continually pound cost average extra funds into each of the ETFs I'm invested in. The previous week has been a particularly strong one for the stock market, and you can see that represented in my rates of return for each of the funds I'm invested in. The only fund that now sits in a negative rate of return is the FTSE 100. However, this has increased from a rate of return of around negative 27% to now sitting at around negative 17%. My investment into the S&P 500 is now up around 10%, with my investment into the FTSE Developed Asia ex-Japan up around 12%. Again, I'm exceptionally pleased with the rate of return I've been gaining at the moment, especially with everything that's going on internationally. Now, there's a lot of discussion out there about a stock market bubble and the fact that this could burst when people realise quite how seriously coronavirus has affected the economy. This has seen lots of the larger investment companies holding cash at the moment to invest in the dip that they see coming in the future. Now, obviously, it's incredibly difficult to predict what's going to happen in the stock market, and therefore, as I've already said, I'm going to continually pound cost average throughout this period, whether it goes up or down. This is the reason I've got a little bit of cash held at the moment, so I didn't do all of my investments on the 27th. This means that if there is a dip, I'll buy into the dip. However, if it increases in value, I'll also buy in there as well. If we have a look at the overall month of May, then you'll see that I've invested £440, which I'm really pleased with, especially because I've also started my trading 212 portfolio. I've also paid my fees this month, which equates to 76p, which is exceptionally good. The market has returned to me £130 this month, and based on the ending balance of my overall portfolio of £3,191, this month I've gained around 4% of the total value of my portfolio. In a time like this, I can't complain with that. Overall then, you'll see that I've contributed £3,150 to my portfolio, with it having a current value of £3,191.78. This sees my investments return to me £41.78, which equates to a rate of return of 2.85%.
So there we have it. In the last few days I've invested a further £340, bringing my total contributions this month to £440. This is quadruple my target monthly investment. I'm really pleased to report my Vanguard portfolio is now sitting on a positive rate of return for the first time since around mid-March. I hope this video has helped you understand a little bit more about Vanguard's S&P 500 ETF, because in my opinion there's no ETF that can beat it at the moment. If you found this video useful, or you're considering investing in Vanguard's S&P 500 ETF, why don't you like the video and drop a comment down below to let me know. If you want to earn extra money each month to help you invest up to £400 each month like myself, why don't you check out my video on match betting, which has helped me make over £400 in extra income, tax and risk-free each month. And also, if you haven't yet used Trading 212 and you're considering stepping into the world of investment on an app platform, why don't you check out my link below, which will give you one free stock up to £100 when you invest just £1. Once again, I hope you've enjoyed this video today, and with that said, I'll see you in the next one.